All right, so the notes for 3-1 here, we're going to start working and taking those 11 transactions that we did last time with the debits and credits and listing the debit first, credit second, in like a T account to kind of keep it straight. We're always trying to keep that accounting equation to equal. Now we're going to go about figuring out how to record a few transactions. This chapter has 4 sections to it, so we're going to have notes over 4 sections. We're going to try to do the first 3 sections of notes this week, so that we can have week 2 of our section or unit be the 4th section and study guide mastery, and then of course week 3 would be the test. So this is kind of our learning objectives. You can see what a journal is, the different source documents, and how to identify the different parts of a journal. Here for journalizing, basically, like we mentioned before, chapter 2 had T accounts where we put the debit and credit parts. It's important to remember debits on the left, credits on the right. A form of recording transactions in chronological order is a journal. We're going to be working in what we call the general journal, just a plain journal right now. It keeps it organized in the sequential date by date order, chronological order. So we're going to be recording these transactions in a chronological order in the journal. The journal is a permanent record, which is important to remember as we keep moving on. Recording transactions into the journal is called journalizing. All right, and each one of these businesses, when they set them up, will use different journals depending on their transactions. Multi-column journal is the kind of column journal we're using. We're going to have a date over here, the account title like supplies or capital or accounts receivable, rent expense, whatever. All the account titles will go here. We'll put the source document, which we're going to learn today, here, like check 1, receipt 1, sales 1, memorandum 1, cash register tape 1, those things. The general debit or credit would be here, and then we have special amount columns. These special amount columns are done to help us simplify things, make it quicker, because cash will be used. We will either receive cash for sales, which is a debit, or we will credit cash when we're paying bills, paying out bills on account, paying expenses. Sales credit is often used whenever we do a cash register tape, when we add up our cash register, or when we make a sale on account receivable type thing. So this is what we mean by multi-column journal. That's what we're working with. 3 special amount columns in the multi-column journal: sales, cash debit, cash credit. This is, like we said, done to save time, trying to make sure that general debit and credit are ones that we don't have, like rent expense account or capital account, because they just don't happen as often as cash. Transactions are recorded in the journal by date. The idea behind this is that we want to record accuracy, that we'll have a debit and a credit for each transaction right now. We call this, every time we do a transaction and record a transaction, an entry. The recording the debit and credit parts of transactions called double entry accounts, because we will go debit and a credit. And so whenever we do this, it'll affect either have a 1 line where we'll have a debit credit, or we'll have 2 where we have like debit supplies and credit accounts payable. And we might have 2 lines. But this is double entry accounting when we record a debit and credit for each of the transactions. Source documents are how we record and register or keep track of each one of our transactions with a note, and we verify it with a source document. Excuse me, it's a piece of paper that we will record the journal entry. Each one will have a source document. There's different types of source documents. We use the accounting concept objective evidence here. Where checks, we will use a check stub. So you'd rip this check and you'd have this check stub. Now, again, this isn't, sometimes a lot of bills are being paid online. We're still going to be using checks. We will get into debit card transactions, EFT, electronic funds transactions, but for our basic purposes, we'll write a check. Okay, so the business form for ordering to pay cash, even if you wanted to pay cash, we're going to be saying it's going to be a check. So the source document for paying cash will be a check. They're numbered, pre-numbered, so each check has a 1 on the check and then on the check stub as well. You record all this information, the date, who it's to, the number written in numerical, the numbers, and then you write out the numbers in English. You put for what the check was for and sign the check. On the check stub, we'll write the amount, the date, who it's to, what it's for, and then we'll keep track of the stuff. So balance brought forward is how much money it is. This is the beginning. So we record the deposit of $2,000 there. 0 plus 2,000 gives us 2,000. This is the beginning of the company, and that's what they're doing there. Others would be like service charge, interest, things like that. So there's none of that right now. So we just bring the 2,000 number down to the subtotal, and then we subtract the amount of the check, 165 here, to the balance carried forward. So that's the source document 1 is checks. So we'll put C1 in the journal. The next source document is sales invoice, and all an invoice is just like a receipt, a form. It could be an order form or a sales receipt, but we call it an invoice when we make sale, a form describing the goods sold, quantity, price, all that on the invoice. All right, invoice used for a sales source document for recording a sale on account. When we make a sale on account to a customer, that would be accounts receivable, and we would use the sales invoice. The sales invoices are done and pre-numbered, like we would said with checks. They're also called sales slips or sales tickets, but almost always we use sales invoice. They're prepared in duplicate. You keep one as the business. You give a copy to the other customer, and those are objective evidence. It's the accounting concept helping us keep track of our transactions. Yet another source document would be a receipt. Whenever we receive cash, again, pre-numbered, we would have a receipt. We give the receipt as a copy to the customer, and then we would also keep the copy ourselves. So when Michael Delgado invests $2,000 in his own company, we still write a receipt, even though it's his company, and we keep it for his books, and then for our company. We keep the books separate, even though it's a proprietorship, sole proprietorship. The business books and his money, his books are separate. So whenever we receive a cash form, we will give them a receipt, and we'll keep one. There's also going to be memorandums. Memorandums are a source document. It's a form with a brief description. Often the memorandums will be like when we buy supplies on account. You get into second semester and we'll have debit memorandums, credit memorandums for when we do some other transactions. But right now our memorandum is just going to be a written brief statement on a source document of something that isn't used. It's not a receipt, it's not a sales slip, it's not a check. We bought supplies on account. We sign it, we keep it, use it in the journal as M1, again, pre-numbered. There's these calculator tapes where we count, basically it's counting the register, pushing the number. We'll get into things like batch reports and things like that later. But at the end of the day, or for us, we don't do it that often, which you probably should in real life, but in our practice for learning, you do it so often that the date is what we're going to count the T is. So January 10th means you're going to do T10, which is the calculator tape or the cash register tape for that date. T for the tape, 10 for the date. Calculator date is a source document for daily sales. And so when we do that, we'll keep it all, even if it's cash, credit card, checks, change, we count it all in one transaction. We'll put a check mark in the journal. We'll show you that later on in a section. We'll put a sales, credit, cash, debit type thing. But for right now, all we're doing is talking about the source documents. Preparing journal entries. Why we're doing it, we want to keep these journals in transaction, date, order. It's a permanent record. We want to keep, detail of money and who we're getting money for and who we're spending money on. It's like a detailed, organized, permanent record of our business. We're going to have a few transactions, not many this section. Record cash from owner's investment. Like we said before, usually our first transaction because we're just starting the sole proprietorship. These are the 4 parts of a journal entry. You need to know the date, which is here, the debit or credit. So we list debit first, so we know Michael Delgado. It says receive cash from the owner's investment, so we know we're debiting cash. Michael Delgado is the owner of this company, so it says receive cash from the owner. We know it's Michael Delgado Capital. Your instruction or chart of accounts will tell you, different examples. We'll have different people's names for the capital. Just look up the person's name and capital in the chart of accounts or in the directions. But for our purposes, receive cash from their investments, a debit to cash, a credit to capital. Increasing cash asset is a debit. Increasing the capital is a credit. And then the source document is R1, receipt 1. You put right here where it says document number, and it's R1. Looking at it from last time on your transaction sheets that you had, those 11 transactions, we did this one. It was the first one. We increase cash with a debit, and we increase, capital with a credit. Okay, again, I just highlighted source document as R, just to remind you. So this should look familiar. We're just taking this transaction from last chapter and putting it into a permanent record of business in a journal. This whole area, again, we've kind of showed you and talked about. This breaks down the 4 parts of a journal and journalizing cash. So if you had a question on 1, 2, 3, and 4 parts, you can look here. That would help you. The other transaction we're learning in this one is paid cash for supplies, $165. Again, early on in the business, so we're on check number 1. That's the source document. But what we're gaining and what we're debiting and crediting, what is being increased and decreased. We are gaining supplies. So if you remember from your transaction sheet last time, which you can use again to help you, we have a debit to supplies. So we will write the date, step 1, who we're going to be putting in the account title, since we're not going to put cash because cash is a special account. We're not going to write sales because sales is a special account type. So what we do is we always put the other one here usually. So we're increasing supplies with a debit. We know when we pay cash or we write a check for cash, we are lowering cash, and so we're crediting it. Source document for paying cash is a check number. That's, again, the accounting concept, objective evidence. This, again, goes step by step with all 4 parts of the transaction if you wanted to look it over. Using special amount column for frequently used accounts saves times. That's why we have cash and sales as our frequent amount columns, because we hope that we will often use these more than others. And that is notes for section 1.